Greetings and welcome to the High Flying Tutors Academy channel. Today I'll be helping you on how to prepare the asset disposal, the asset account, and the accumulated depreciation and depreciation account, right? And on how to calculate depreciation using the straight line method, a very easy method, most of the people they say. So I'm going to read the question and then we'll take it from there. Here we've got this question. We also have the answer sheet there, right? And we also have the working sheet, right? So let's start with the question. The question is as follows. On the 1st of March 2013, Roy Traders owned 2 vehicles with a total cost price of 80,000. The accumulated depreciation on the 2 vehicles amounted to 11,500. On the 1st of March 2013, depreciation on vehicle is calculated at 15% per year on the straight line method. Vehicle A was purchased on the 1st of March 2011 for 30,000 rand, and vehicle B was purchased on the 1st of November 2012 for 50,000. And then it means this 50,000 plus 30,000 makes an opening balance of 80,000, right? That's where the 80,000 comes from. And then on the 1st of September 2013, Roy Traders purchased vehicle C for cash for 70,000 and sold vehicle A at 20,000 cash, right? So note, financial year end on the 28th of February each year. You are required to prepare the following ledger accounts for the year ended 28 February 2014 and must be properly balanced and closed off, right? Number one, you're going to have to prepare a vehicle account, which is an asset account, accumulated depreciation account on vehicle, depreciation on vehicle, and asset disposal, right? So now I want us to go and prepare number one, the vehicle account. Remember, vehicle account only record the cost prices of the cost prices of the asset. Where there is an increase in the cost, maybe there was an additional vehicle that was purchased, right? Or how much did we open with? How much is the cost price at the beginning, right? And also indicate the cost price of the asset disposal where we have maybe sold a vehicle or traded in, right? So now today, but when we check there, we have sold a vehicle, right? So let's go and record and prepare a vehicle account. Number one, we need to go to the worksheet. We go to the worksheet and we determine the financial period, number one. That's step number one. Step number one. We have to determine the financial period. So the financial period there, financial period So step number one, we determine the financial period. So when we check on our required part there, they say we have to prepare the ledger accounts for the year ended 28 February, right? 28 February there. This is our year end date, or the last day of our financial period, right? Therefore, we're gonna say our year ended 28 February 2014. And then when did we start? Remember, in our financial period should be 12 months period, right? Our financial period should be 12 months period. So it means our year started on the 1st of March 2013. If you count from there, from March to 20, from 1st March 2013 to 28 February 2014, that is a 12 months period financial. I mean, that is a financial period for 12 months, right? 12 months. Our financial period is going to give us 12 months. So now, what you must do here, already now you know that you are working on which period. You are working on the period that started on the 1st of March 2013 until 28 February 2014, which is 12 months period, right? And then number two, you must know that your opening balance is going to come from this date, right? So when we go into our question there, we realize that they said on the 1st of March 2013, Roy Traders owned two vehicles with a total cost price of 80,000. So this 80,000 cost price at the beginning is going to be our balance brought down. Our balance brought down means opening balance of 80,000 with the vehicles that we have at the beginning of the year, right? And then as we check our question there, if you check this additional information here, it says on the 1st of September 2013, Roy Traders purchased vehicle C for cash for 70,000, right? So you go into your vehicle account, you're gonna say bank because you purchased it for cash. You're gonna say bank, and then you say 70,000, right? Okay, and then it also continues to say, and sold vehicle A at 20,000 cash. So you sold a vehicle A, right? Remember, you have to record a cost price, initial cost price of the asset when you prepare an asset account like vehicle now, right? So when we come here, since we sold a vehicle, when we sell a vehicle, that is an asset disposal. That is asset disposal. We've disposed a vehicle, right? So we're gonna say asset disposal on the credit side, because asset disposal, it's like a decrease in our vehicle because we've taken the vehicle out. We've sold the vehicle. So whenever an asset decreases, we credit, you remember. So now you're gonna say asset disposal of 30,000. Remember, the cost price of the vehicle A is 30,000, right? The 20,000 that we received when we sell is going to be recorded under an asset disposal account. That's why we're going to account for it, right? But here we only account for the costs. Are you with me? And then now we have to check which side is bigger, because looking at our additional information or our questions there, I don't think we've got any other transaction that speaks about adding more vehicles or selling more vehicles, right? So it's only 70,000 vehicle that is new that we purchased, and then it's an addition. So there's an increase in our vehicle. We said bank 70,000, right? Because asset, whenever we buy additional asset, we must record on the debit side because asset increases on the debit side. So now we're going to look on which side is bigger. I look of things, the bigger side there is our debit side, right? So we're gonna say 80,000 plus 80,000 there plus 70,000 is gonna give us 150,000. That is our total there. 150,000. Even on the other side, it's gonna be 150,000, right? And then 50,000, 150,000, I mean to say 150,000, 150,000, right? And then we have to have what we call balance carried down. Balance carried down means closing balance, right? And then we have to say we had the total vehicles of 150,000. Then we're going to say 150,000 minus 30,000, right? We want to see how much cost of vehicles do we have in the business now, because we have sold the one that cost 30,000, right? So it's going to be 150,000 minus 30,000, of which we're going to get 120,000 when we close our books. We are closing with 120,000 vehicles, right? And then these vehicles, as we close with them, we have to indicate on the credit side below balances that this is the balance that we're going to open with in the following year. Because any amount or any cost that we close with, we're going to open with the following year. And when they say on the question or additional information here, if you check the required part, they say these accounts that you are preparing must be properly balanced and closed off, right? So when you balance properly or closed off is when you indicate is when you balance off here, you close, you show your totals that they are the debit side and the credit side are equal, and you also indicate that the opening balance, the closing balance of this year will be the opening for the following year. The closing balance for this year will be the opening for the following year, right? So that is how you balance off and close off properly. Yes, that's how we indicate the close off and the closing off and the balancing off properly. You indicate the totals there, that they are equal both sides, and you also indicate that the closing balance for this year is going to be an opening for next year. I hope you're going to get this one. Okay, so now we also have to prepare our account, accumulated depreciation account. We also have to prepare our accumulated depreciation account there. But before we prepare this one, we need to calculate depreciations, right? For each account, for each asset that has been for each vehicle, for each asset or each vehicle, because if you check, we've got a vehicle that was traded in, we've got a new vehicle, and we also have the remaining vehicle because we bought a new vehicle and then we sold another one, and then there's another one that is remaining. That means we're going to have 3 vehicles, right? So now let's go and check the question again. I just want to show you something there on the question. If you check there on this question there, on this statement, they say the accumulated depreciation on the 2 vehicles amounted to 11,500 on the 1st of March 2013. So these amounts will be this 11,500 will be our opening balance for accumulated depreciation, right? Because remember, our opening balances are going to be found on the 1st of March 2013 because the 1st of March 2013 is our opening date, right? Is the date at the beginning. So we're gonna come this side here and record the opening of 11,500 on the accumulated depreciation, right? And then now for us to complete this account, we have to prepare or calculate the depreciations for each asset or for each vehicle. Remember, number 1, to make things easy, step number 2 is depreciation calculations, right? Let me just do this. Step number 2 step two, because this was step one, right? This one is step two. So step two, you have to calculate depreciation. Depreciation. All right. So step number two, you have to calculate depreciation. Number one, under depreciation, we have to calculate depreciation for the new vehicle. That is the easiest, right? To calculate, we have to calculate depreciation for the new vehicle. Depreciation for new vehicle. Right? So just gonna put a bullet there, right? So that you see it's under calculating depreciation. So if you want to calculate properly, there's certain things that you need to identify. If you want to calculate depreciation properly, let's put the steps that we must follow, or what are the items we need, right? I'm gonna insert a small table there for 2 columns. That will help us. Right? So number one, this side is gonna be amount there. So number one, you must determine the cost price, and then the cost price. Number two, the percentage of the depreciation. Number three, the method that you're going to use to calculate depreciation. And then number four, you determine the period, right? So now this is what is going to help us to calculate our depreciation correctly. Remember, we are starting to calculate depreciation for new, right? For new vehicle. That's how I prefer, and that's how I believe most of you will understand how we do this thing. So now let's go back to the question. So on the question here, they say we bought a new vehicle, which is vehicle C, right? For cash, 70,000. So the cost price of the new vehicle is 70,000, right? 70,000 there. Just want a bright color there so that you can see. Let me do this. I hope you can see there 70,000, right? So let me just put it in a bit. Let me highlight it. Yeah, I think you can see this one. And then 70,000, right? So now we determine the price, the cost price, 70,000 rent, right? That's number one thing we must do there. We've got 70,000 rent. Okay, and then the percentage, let's go to the question again and check what is the percentage to calculate depreciation. It says depreciation on vehicles is calculated at 15% on straight line method, right? Depreciation is calculated It's calculated 15% per year on the straight line method. So already we've got the straight line method and the 15%. So we go this side of our workings. We're gonna say is 15%, and then method is straight line method. Straight line method, right? So straight line method, and then the other name for this method is called cost price method, right? So straight line method or cost price method. And then the period we're gonna have to check when was this purchased, right? When was this purchased? Let's go and check there in the question. So this vehicle was purchased on the 1st of September 2013, right? It was purchased on the 1st of September 2013. So it means this vehicle was there from the 1st of September 2013 until the end, till 28 February, till 28 Feb of February, right? 2014, right? So we have to count how many months was this vehicle in the business. So we're gonna say September, October, November, December, January, February. I got 6 months, so you put 6 months there. That is the period, 6 months there, right? 6 months there. So the straight line method or the cost price method to calculate depreciation, the cost price or straight line method. It says cost price multiply by the percentage you are given, multiply by number of months divided by 12. It's equal to your depreciation, right? Okay, and then now we have to calculate depreciation. When we calculate depreciation here, we're going to check for the new, right? We're going to say 70,000, which is the cost price, 70,000 multiplied by the percentage given. The percentage given, remember, is there, 15%, which is 15 divided by 100, multiplied by 6, which is number of months, divided by 12, right? How much is the depreciation right there? How much is the depreciation right there? The depreciation is giving me 5,250. 5,250. That is the depreciation for the new vehicle. 5,250. Right. This is the depreciation for the new, right? And then we also have to go and calculate depreciation for the traded in, depreciation for the, for the sold, depreciation for sold, not traded in, depreciation for sold or disposed vehicle, right? Disposed vehicle. We have to calculate depreciation for the disposed or sold vehicle, right? So we're gonna have to use the same table. We're gonna have to use the same table there. Copy this one and then try to follow here, right? So now, remember, what is going to change is the cost, right? For the new, the cost is going to change and the period is going to change. The period is also going to change, right? So I'm going to delete this one and the months they're going to change, right? So when we calculate depreciation for the new, for the sold, when we calculate depreciation for the sold, we have to determine the cost price. The cost price. Let's go to the question. So the question says vehicle A, actually like the sold is vehicle A, right? Because it's the one they sold. So they say vehicle A was purchased on the 1st of March 2011 for 30,000. The 30,000 is the cost price. Is the cost price for is the cost price for the vehicle that was sold, right? So we come this side of the workings. I'm gonna say the cost price there is 30,000, right? And then the period this vehicle was there for how long in the business? It was there from the 1st of March. It was there from the 1st of March 2011 until or till we sell it. When did we sell this? We sold this on the, let's see, we also sold this vehicle on the 1st of September 2013, right? So, but this vehicle was there from the 1st of March 2011 until the 31st of August. Then on the 1st of September, we sell it. So when we calculate depreciation, hear me clearly here. When we calculate depreciation, we cannot consider the 1st of September 2013 because on the 1st of September, we have sold the vehicle. So that means the vehicle was there from the 1st of March 2011 until the 31st of August 2013. So that's how we're going to calculate depreciation for this one. So it was there from the 1st of March 2011 until the 31st of August 2013, right? So now let's see how many months, right? Because I think it's going to be number one there. We're going to have year one, year one, year one is going to be 1 March 1 March 2011 to 28 February 2012, right? And then it means we have to calculate depreciation for year one, which is the vehicle was there for the whole year, right? So remember, we are following which method? The straight line method, this one, right? We are following this method. So I'm gonna just copy it here, bring it down here so that we can be quick, right? So it's gonna be here, right? So year one, we follow the same method. Actually, let me put this method up there. Let me put it on top there, above the year, right? So that we can just be able to separate these things. So we're gonna use the same method, the straight line method. It didn't change, right? So now, year one, we have to calculate depreciation. So we're gonna follow the same method. It's gonna be 30,000 multiplied by 15 divided by 100 multiplied by 12 divided by 12. Because if you check here, it was there for the whole year in year one, right? So how much are we getting there? We're gonna get 4,500, right? And then year two, year two, 1 March as well. It's going to be from there, from 1 March, because we have to calculate depreciation year by year. So it's going to be 1 March 2012 to 28 February 2013, right? So it's the whole year as well. So it's going to be 30,000 multiplied by 15% multiplied by 12 out of 12, right? So we get the same as year one, which is 4,500, right? And then now from there, we already know that we have got 12 months year one, 12 months year two, that's 24, right? But remember, the vehicle was sold on the 1st of September 2013, of which it was there from the 1st of March 2011 until the 31st of August 2013. So it means we have to calculate year three now. year 3, which is our current year, is going to be from the 1st of March. It was there from the 1st of March 2013 to 31st, from the date of sales, which is 31st August, right? From the 31st of August 2013, because on the 1st of September we sold, so it cannot be, September cannot be counted as a month because it was sold on the 1st, right? So we cannot include September when calculating depreciation, just to repeat and make sure that I emphasize on this one. So now, how many months there? From the 1st of March, from the 1st of March 2013 to 31st August 2013, let's count. There's going to be March, April, May, June, July, August, which is 6 months. So this vehicle in the current year was there for 6 months. So let's calculate depreciation following the method. The method says cost price, which is 30,000, right? Multiply by the percentage given, which is 15%. Multiply by 6, because we found 6, right? Number of months, divide by 12. So how much is the depreciation there? Let's see. So when we calculate depreciation there, following that method, it gives me 2,250. 2,250. That is the depreciation for the current year for the sold or disposed vehicle, right? We've got depreciation from the day. We've got depreciations for 3 years. So it means year is 3 years and a half. If you see, so 3 years and a half is going to be 30 months. 30 months, that's the period. That's how I determine this one's period, which is maybe I can say 2 years. 2 years and 2 years and half. 1/2. 2 years and half. All right. So that is the period for 2.5 years. Right? 2.5 years. 2.5 years there. Yeah. So you see now. So that is the thing. That is the period for the sold or disposed vehicle. We calculate depreciation for the first year, for the second year, and for the third year, right? How much is the total accumulated depreciation until the date of sales? Total. We also have to calculate total accumulated, or maybe I will say, let me just call it accumulated. That's how maybe you will understand better. Accumulated depreciation until the date of sales. Accumulated depreciation until the date of sales. Until the date of sales. So it's going to be equal to depreciation for year 1 plus depreciation for year 2 is 450 as well, plus depreciation for year 3, which is 2250, right? So how much is it there? Let's see, depreciation for depreciation until the date of sales is equal to, let's see there, it's equal to it's equal to, let's see, let's calculate there. It's going to be equal to it's going to be equal to is going to be equal to 11,250. 11,250. This is the depreciation until the date of sales, right? We added year 1, year 2, and year 3. Okay, and then now let's proceed. Let's proceed. We also have to calculate depreciation for the remaining, right? We have to calculate depreciation for the remaining because we calculated depreciation for new. Here it is. Depreciation until the date of sales for the sold. It's very important to calculate this one as well. And then now we have to go and calculate depreciation. We're going to calculate depreciation for the remaining or old vehicle. Some people call it old, but I call it remaining. So remaining asset or remaining vehicle. So remaining vehicle, we're just going to calculate depreciation for this year only, right? So because it was there for the whole year. So remaining or old vehicle, remaining or old vehicle. So we're still going to have to use the same table. Still going to use the same table. Copy there. I'm going to paste it this side. I'm going to use the same table. So remember here, the cost price is 30,000, right? 30,000. It's not 3,000, it's 30,000, just to rectify that one. And then now, here we have to remove the cost there. We also have to remove the period for this one. Also have to remove the period for this one, okay? And then even the period for this one. Remember, I tell you that the period for the remaining or old, it has to be 12 months. That means, and we are only calculating depreciation for the current year from the 1st of March. From the 1st of March. From the 1st of March 2013 till 28 Feb or 28 February 2014, which is the whole year of the current year, right? That is the period, right? Which means the period here is going to be 12 months, right? And then let's go back to the question just to check, just double check, right? So the cost price for the remaining vehicle, which is vehicle B, because it was never sold, so it means it was there for the whole year, right? Vehicle B, it was there for the whole year, this one, right? It was there for the whole year. So we're going to calculate depreciation for vehicle B for the whole year. We are only going to calculate depreciation for the current year only, right? So let's go to the working sheet there, or the worksheet. So remember the cost price for vehicle B, which is the remaining or old vehicle, is 50,000, right? And then now we've got everything. And remember, we are using this method, the cost price or straight line method, right? So we're just gonna put it here. Just gonna put it down there. I'm just gonna put it there. Okay. There we go. And then now we're gonna follow that method to calculate depreciation for the old or remaining vehicle, which is, we're gonna say cost price, which is 50,000 multiplied by 15%, percentage I given you there, which is 15 out of 100, multiplied by 12 out of 12, because it was there for the whole year. Okay, so how much there? How much there? How much there? How much there? I get 7,500. 7,500. Right now, we are done calculating depreciation for all all the vehicles that we have there. Remember, we've got the new vehicle that costed 70,000. We've got sold or disposed vehicle with a cost price of 30,000, and we've got the old vehicle or remaining vehicle with a cost price of 50,000. So we need to record this in the accumulated depreciation account. Let's start with the new. The new vehicle has let me do this here. Just indicate this one there. Light with yellow. Okay, so now let's go and record this depreciation. These depreciations are going to be recorded on the credit side of the accumulated depreciation account. Number one, we've got depreciation for new, right? We're just gonna come here and say depreciation. Number one, depreciation of the new is 5,250, right? And then we go and check depreciation for the sold for the current year. We only do recording depreciations for the current year, right? Depreciation for the current year for the sold is this one, right? It's this one, 2,250, right? And then we go to the answer sheet there, we say depreciation again. Depreciation of the sold, which is 2,250, right? And then we go and check depreciation again for the sold or for the old or remaining, right? Depreciation for the old or remaining is 7,500. So we go again on the answer sheet there, we say depreciation. Usually when you prepare other stuff or in a different format, we put dates, right? But no problem if you put it like this, depreciation. I don't think this will cost you much, so you can put it like this. And then we've got depreciation for the old of 7,000 or remaining of 7,500, right? So now we are done with all depreciations. Are you with me there? Right. And then now we need to also record the asset disposal depreciation until the date of sales, and we're going to call it asset disposal on the debit side of the accumulated depreciation, asset disposal. And then how much was it? Let's go and check there in the worksheet. Remember, we calculated it is this one. The accumulated depreciation until the date of sales of that vehicle that was sold is 11,250. We're going to record it on the debit side of our accumulated depreciation as asset disposal there, 11,250, right? Then we are done with this account. We just have to balance and close off, right? So we check which side is bigger. We have to check which side is bigger, right? When we check the bigger side is the credit side with an amount of 26,000. After adding the 11,500, you add all the depreciations here. You're gonna go at 26,500. So even on the other side, the total will be 26,500 because all the sides must be equal. Then we're gonna get the difference. Then the difference will be the closing balance of the accumulated depreciation. So it's gonna be 26,000 minus 11,250, right? And then let's see how much is it there. 26,500 minus 11,250, I got 15,250, right? And then now remember, this is the closing balance for the current year, and then it's going to be the opening on the other side there, the opening for the following year, right? So this is how we close or balance off and close off properly, right? Like we did up there, we're also doing it here. Okay, this one there and this one, it must also come there. So this indicates that this is the closing balance for this year, and it will be an opening balance for next year, Right, so now we are done with the accumulated depreciation account, right? We also have to go and prepare the depreciation account according to the required part of the question, right? We are done with this one. With these two, we are done, right? We are done with the two. We're done with the two, and then we are left with the two. We are left with depreciation. We are left with depreciation account, and we are also left with asset disposal account. Let's go and prepare the depreciation account on vehicle, right? So let's go to our answer sheet there. So on our answer sheet, what we have to do, you just have to use the double entry system or duality principle. Duality principle, we're gonna just have to say these depreciations, when they go into our depreciation account, they're going to be called accumulated depreciation. I'm just want to say accumulated dip, right? Accumulated depreciation there, number one. And then we also gonna copy and paste on the other side, or on the other rows, because it's the same thing. Remember, we've just put depreciation on the other side. So these, all of them will go to the depreciation accounts as accumulated depreciation. This is what I'm applying here. It is called duality principle or double entry system. And then obviously the bigger side is going to be this one by how much? We add 5,250 plus 2,250 plus 7,550. You add everything there, you're going to get a total of 15,000, right? This 15,000 must also be closed off this side. Must also be a total of the other side, because remember, all side, the debit side and the credit side must be equal, right? And then now we're going to close off this account with profit or loss, because depreciation is an expense account that will be recorded in the profit or loss account or profit or loss statement, or the statement of profit or loss and other comprehensive income, right? So we're gonna say profit or loss. So this is an expense account, not an asset account. It's an expense account that will be recorded in the profit or loss account, right? Not asset account, but an expense account. So with 15,000, right? Then this is how we prepare the depreciation account. Remember, if you got it wrong this side, definitely even this side you're gonna get it wrong, and then it will be a loss of marks. So you need to be careful when you do your calculations of the depreciations from your workings there. You must do it nicely, because the main thing is the N. Once you get the N right, or the number of months right for each item or for each asset, or maybe a vehicle or any other asset that you'll be required to do accounts for, then you'll be right. Nothing will be difficult if you are able to get the N right. Are you with me there? Right. So let's go back to our account there. We need to prepare our asset disposal account. Since we are done with the depreciation account, we need, according to the required part there, we are done with this one, right? So now we are going to prepare the asset disposal account. Okay, so let's go back there. So no more questions, right? We don't have to go back to the question anymore, right? When we come here, we're just going to say vehicle. I'm also using a duality principle here, or a double entry system principle, where I'm going to take this 30,000 from here, right? This 30,000 from the vehicle account, then I'm just going to copy there, and then I'm going to paste it on the debit side of my asset disposal account, right? Paste it there. Okay, and I'm also going to have accumulated depreciation on the other side, right? I'm going to have accumulated depreciation. I'm just going to copy this here, because I have to record accumulated depreciation on the credit side of the asset disposal. But which one? I'm going to take this one, duality principle. I'm going to take this one, 11,250, right? Copy there, I'm gonna put it here. See now, very easy, just to make things quick there, right? So this is how we do it. And then now on the debit side, I'm on the credit side, I mean to say, I'm also gonna record the cost, the selling price, of the vehicle, of which they say we sold this vehicle A with a cost with a cost price of 20,000, right? We received 20,000 cash after we sold the vehicle A, right? So I'm gonna go to the credit side of the asset disposal and say bank, because I received cash for that. Say bank 20,000 there, 20,000. Then I'm done. Now, since I'm done, I just have to close off this balance, this account properly. I need to close off the asset disposal account properly. So when I check them, I just need to check which side is bigger. By the look of things, the credit side is bigger. So I'm going to say 11,250 plus the 20,000, it gives me 31,250, right? 31,250. Even on the other side, it must be 31,250. So when we prepare the asset disposal, we want to check after selling this vehicle, did we make a profit or loss? So if the credit side is bigger, like now, the credit side is bigger than the debit side, we made a profit. So we're going to say profit on sales. Profit on sales. So profit on sales is going to be the difference between 30,000 and 31,250, which is 1,250, right? Then that is our asset disposal. So if our debit side was bigger than the credit side, we're going to have a loss on the credit side. It either is going to be a profit or a loss, right? It can be both. Remember, it's either a profit or a loss. So if we had debit side bigger than the credit side, therefore we were going to have profit, I mean a loss on the other side. So it was going to be accumulated depreciation, bank plus loss, and then this side we're only going to have vehicle, right? But now because our credit side is bigger than the debit side, therefore the difference between the two, it's a profit of 1,250. This is the end of this session. Thank you for watching and salute.